Welcome back to Real Estate Economics Weekly Webinar Series. This week we're talking about the Salt Lake City metropolitan area, MSA in particular. Let's start into housing supply and demand, and we'll also talk about whether this market is overbuilt and underbuilt, and whether this market is overvalued and undervalued in this particular section. As we mentioned in section 1, permit levels are very low. You can see that in this particular graph in the blue line. That is the supply of housing. In this market, just like almost every other market nationally, supply tends to grow slowly and steadily. It's difficult in almost every area to add supply very quickly, just because it's often complicated to assemble the land, get the building approvals, formulate a product, get a construction loan, and so on, ultimately deliver houses. So supply tends to grow in a very measured and steady pace. By comparison, demand for housing oscillates quite a bit as a response to employment conditions. When the job market is good, employment grows very quickly, demand grows very quickly, and the only way for that demand to outlet itself is through higher home prices. During periods of recession, employment can fall very rapidly, as we've all seen, and when it drops suddenly and substantially, the housing stock, local housing stock in the MSA, essentially becomes too large for the employment base. That means there's really too many houses on the market. It's a buyer's market, prices draw down, and interested home buyers have many more choices, which makes house prices degrade and makes sellers offer concessions. If you look at the current period in this chart, the years 2010 and 2011, you can see at present the supply is too large in comparison to demand, and it's going to take several years of employment growth for that to stabilize itself and for equilibrium to return to the supply and demand equation. We can measure that numerically in this particular graph. In the periods that are above the red zero line, the market is underbuilt. Those are periods of strong employment growth where improvements in employment are making people go out and shop for homes that aren't necessarily there. There's more demand in the market than there is supply, and prices tend to rise. The overbuilt condition at the bottom, pointing down in the red lines, is when the economy is contracted and there were fewer jobs. We quantify this numerically in terms of being overbuilt or underbuilt, but you could just as easily refer to it in terms of employment, in that this market would be overemployed or have high employment or have low employment, and that's translating directly back to demand for the housing units and creating these overbuilt and underbuilt conditions. Let's look at housing valuation. Historically, valuation has been fairly well correlated between the median home price and the supportable price. Now, when we talk about supportable price, we're talking about what are the incomes in this market area, what price home can the local incomes afford at prevailing interest rates. So we can take long-standing, we know the incomes, we just talked about those in a previous slide, we know the mortgage rate, so we can calculate over an extended time period what the median supportable home price is. Usually, that's close to the actual home price because people have to qualify for their loans. They go through an underwriting process, people look at their bills, and so those, the value, supportable value, and the median price tend to stay pretty close together until subprime came along. Suddenly, those relationships are broken. All of a sudden, people can qualify for a loan and buy a home that's much more affordable than they could in the past, and ultimately it's proven to be much more expensive than they can afford. You can see that where the blue line here spikes in the 2007-2008 time frame. Now, we all know how that ends. Ultimately, we're paying that back now as the blue line drops back down closer to 200,000 and takes numerous years, many years really, throughout the end of the forecast period to rebuild back to where home values were last in 2007. You can see in this green line a sudden spike in what the supportable home price was. Now that spike is produced by the Federal Reserve's intervention in interest rates. When they lowered rates, suddenly the same household income that's in this area can afford more home. Now you say, well, wait a second, if people can suddenly afford more and incomes are staying up, how come they're not out there buying houses like crazy? Well, in some sense, some parties are. Rental investors are very active. There's many people searching out homes with good rental demand. They're buying those homes. They're sitting on those 5 or 10-year time horizons. Owner-occupants are much more cautious. Now they want to wait until their job conditions are good. They want to wait until they're certain they have steady employment. People are marrying later, particularly nationally, and forming households at a much slower rate. The recession and subsequent economic slowdown has really retarded household formation in a lot of markets and pushed people back age-wise. You can see here median home price trends in this market. The 1990s to 2000 period was very, very good. Even in the dot-com years here, 2002 and 2003, this market did not go negative. It lost a lot of its momentum, but some of the very big high-tech markets, you could see a considerable downdraft in prices. Prices here stayed positive. Then we had a large rebound in the middle of the last decade, 2005, 2006. Since 2008, we've suffered about 12% price degradation. I know if you're living this or you own a home in this area, it's been frustrating and trying. These declines in value are far less than we know the surrounding markets are experiencing, and we'll ultimately start to see a little bit of a reversion towards appreciation here in the coming years. I like to call it a price correction or price improvement versus appreciation, because what we're really getting is a steadying effect, a recognition of the undervaluation that's in place on the ground here. We see many older buyers, or not necessarily buyers of age qualified, but mature buyers who've been through a couple of real estate cycles have been more active in the market because they can recognize the undervaluation much more than younger people can. We've seen in many markets parental support for their children to buy homes and that sort of thing. Let's look at this numerically in terms of our over and under supply. You can see here when the total jobs increased quite a bit as they did in 2006, 2007, 2008. The market is characterized on the right in blue as being underbuilt. The employment, as we mentioned earlier, grows much faster than supply, causing the market to be characterized as underbuilt. It's only when employment reverses and we have a loss of jobs that the market is characterized as overbuilt. Yes, the market's adding supply. There are new homes coming to market, but not nearly in the numbers that would be necessary to cause the change from overbuilt to underbuilt or vice versa on its own. It's directly a function of employment. You can see our weak economic conditions in 2009 and throughout most of the forecast period will make this market behave as if it's overbuilt. There are too many units for this employment base, and essentially create a buyer's market presently and out into 2014 and 2015 when we start to reach equilibrium again. Now, as we mentioned in the last section, a lot of the homes are older and less desirable, so we don't think it's going to take a full mathematical or numerical equivalence here to produce upward pressure on prices. The worst units are going to continue to settle to the bottom and produce some improvement before we have a numerical equivalence. Let's look at this on an overvalued, undervalued basis. As we mentioned, incomes are very steady. When rates dropped suddenly, it takes less household income, or a smaller portion, I should say, of your household income goes to the mortgage. You can see that at the center of the table. During 2007, it took approximately $13,869 to afford the median house at the median household income. That number has dropped all the way down to $10,000, so homes are very affordable. So we're calling those undervalued. Again, that undervaluation is not being recognized by everyone in the market due to poor sentiment, poor job conditions, uncertain employment prospects, but houses are very, very cheap. You lock down a good house now with a fixed rate mortgage, and you'll enjoy low ownership costs for years to come. We've talked in some of our past series about lumber prices. This is one of the things we would consider a leading indicator of future housing demand. Once we believe that the economic market and the financial markets recognize there's a pending improvement in home conditions, in the home market, in the housing market, lumber will begin to accelerate in terms of prices. Now, what this lumber is, this is 2x4 framing lumber, traded on the Chicago Mercantile Exchange. The price on the right scale is per 1,000 board feet. So you can see the market's been as low as about $240 per 1,000 board feet in July and August, and it's come up to over 300 at a couple of times during the past several weeks. Now, this is the March contract. We like to look at that contract because it would be spring that large users, wholesalers, people who manufacture wood products would want delivery of this lumber for their summer, spring and summer building deliveries. Now, what's happened here, as with our quantitative easing and the loss in value of the dollar, is we've got speculators starting to come into this market and take open positions here. You can see in the very bottom scale, the open interest is suddenly increasing. This is no different than what's been taking place in copper, cotton, soybeans, and a whole bunch of other things. This excess liquidity is finding its way into different markets. Now, I'm cautious about this because this undermines higher lumber prices, obviously damage feasibility in terms of home building, and the introduction of large speculative purchasers here. They will compete with the commercial interests, and ultimately, if conditions are right, have the propensity to drive prices suddenly higher or suddenly lower, based on a bit of news or a change in direction of any sort. What you've seen here today is quite a bit of this comes from what we call our OR report. That's opportunity risk. Our whole section about overvalued, undervalued, oversupplied, undersupplied comes out of our opportunity risk report, which we create not only on a national basis, but for hundreds of MSAs across the country, Salt Lake included. You can look at any particular area and see the conditions. Is it overbuilt? Is it underbuilt? And we put that into a larger single index that forecasts market conditions out 24 months. You can see if your market is stable, improving, so that you can anticipate conditions on the ground before they're evident on the ground. You can make land purchases. You can find out which areas to be in terms of MSAs across the country and which areas to avoid long before everyone recognizes that on the ground. If anyone's interested in webinar sponsorship opportunities, I'll give you contact information for that. Some of the other things we do, asset valuation. We see quite a few broken subdivisions these days. We do as-is and partially complete improvement values. One of our specialties, land value optimization. If you have land that has an undetermined or a use that you think is probably not the same as it was 3 or 4 years ago, we're happy to look at that and draw quite a bit of additional value. Surprisingly large improvements in value can be had in some of these situations. Workout, build-out strategies, and liquidation distribution. Here's our contact information. Many of you know Mark Bowd. He's the principal here and does many of these webinars. If you look back through our webinar series, Mark and I tend to alternate those. He seems to get all the good markets. Just kidding, I love Salt Lake City, one of the most beautiful small cities in the country. I'm John Mulville. If you saw anything of interest today, I'm happy to answer questions or talk to any topics you'd like. Our Director of Sales and Marketing for these products is Judy Duell. Her information is shown here and always on our website. And Sandy Rivera, if you're a user of any of our products and want to make sure you're getting the most out of those, want training for your staff, want introductions to any of the things we do, let Sandy know, and we can often run through those with you and show you how those are all used. We are the biggest users of those products here, so we know how those work and how to get the most out of them. Thank you very much for joining us today, and please join us for future webinars.